Hello, everybody. Welcome to another Daily Plan. I'm your boss, Joe Boss. We had a bit of a surprise today, at least for myself. We had pretty mixed European flash PMIs. They weren't terrible, but they weren't great. And then the US flash PMIs came out, and those were effectively flat. So technically, the US is in a better position growth-wise, because those PMIs are used for a lot of growth indicators, than the European side of things. And everyone is wondering, oh man, why did stocks jump today? It's the flash PMIs on the US side. They came out good. Good for the United States. And if you're familiar with your dollar smile theory, when the United States is at the head of the growth curve, when the United States is growing faster than the rest of the world, the US dollar tends to get a bit stronger, but also US assets tend to get a bit stronger. When the US is doing fine and the rest of the world is growing at a faster rate, then usually the dollar tends to depreciate, but equities in the US and around the world are still hunky-dory. When things are going terribly, when the stock markets around the world are falling and there's some financial crisis or geopolitical event that causes a lockdown all around the world, guess what? The dollar tends to get stronger in those scenarios. So it's called the dollar smile, because in really, really good times, the dollar gets strong. And in really, really bad times, the dollar gets also strong. But somewhere in the middle, when the rest of the world is doing better than the United States, but everyone's still chugging along at a positive rate, the dollar can get weaker there. So today was not one of those days. I was expecting effectively flat US flash PMIs, which is what came out. But the rest of the world's PMIs, especially in the Eurozone, came out mixed, slightly negative. So we're at one of the edges of that dollar smile, which kind of helps explain the move that we'll see in quite a decent number of charts for today. We're going to try and focus on probabilities of maybe where we're going to end the week using the probability pivot points and the range probabilities. I know I haven't been moving my chart around a whole lot. Don't worry, the screen's not frozen. Well, actually, let's go ahead and pull up our probability pivots. And I'm going to do something here. I'm actually going to go to a daily chart with weekly pivots. And there we go. So we can see usually for this week, most of the time, seasonally, for the last 34 years, this week closes around here or down here. So this is a particularly strong and bullish bar. And now you can see my drawings. These arrows here are time stamped from last Friday. That's when I drew them. So it looks like we hit this expectation, this bullish expectation right here. And don't get me wrong, maybe something happens in the next 24 some hours that pulls us back lower. I would like to see that myself with the positions I'd like to have on right now. But I'm not going to try and sugarcoat it. This is a very strong bar. And this can lead us to close higher than I originally expected. You can't stay married to particular positions. when new information comes out, you have to be ready, willing, and able, RWA, to update your expectations as quickly as possible. So then you can try and protect yourself. And then we can also see the probabilities for next week's odds. We'll be going over a week ahead trade plan for all the assets that I usually cover here on the stream tomorrow, in tomorrow's week ahead trade plan stream. So make sure to tune in for that. I'll send out the announcements on Discord, and you can subscribe and put notifications on for that. But if we go around and we look at the world of assets, you can see NASDAQ spiked up on the flash PMIs. It did well, but it totally reversed. The Dow, stronger, nice to see. The S&P, stronger, but reversed a bit. The Russell, it's been on a rip roar and a tear. Again, these are just the Russell E-mini futures. Let's see here. How about Japan? Japan also doing pretty darn good right now. Speaking of Japan, the dollar yen is in a really strong spot. And next week, seasonally, I'm looking at this for next week and I'm like, oh man, 153 is potentially on the table here next week if we close at the current price. This is really strong movement out of the yen. Well, weak movement out of the yen, I should say. Strong movement out of the dollar yen exchange rate. All of these, I mean, especially the pound yen got hit for like 100 pips. It totally reversed this move. All of these yen pairs really did get hit. Their momentum kind of took a big hit, you can kind of see. But this dollar yen is a particular concern because, you know, if you look at this, let's say on a higher time frame, if we look back, it's during periods like this when you're priced this high that the Ministry of Finance out of Japan likes to get involved in markets. They don't like the yen being this weak against the dollar. It can accelerate inflation faster than, frankly, than they'd want. Maybe that's something they actually want to see, is that inflation to come through here on this front. But here, let's see. Ain't no way the BOJ won't intervene, right? It's the Ministry of Finance. I don't think the BOJ is going to intervene. Maybe they'll get on to some more hawkish policy if Ministry of Finance doesn't intervene by this point right now. I'm currently waiting to see if Western Nakamura has sent me anything in my inbox, because I am dying to read that guy's commentary. But this is like flashing red warning zone as far as the price, because the Ministry of Finance could intervene and do some yen intervention. And that would drive the yen stronger. And, I mean, imagine the yen just gets stronger. You end up falling essentially to 300 pips from here. Because that's usually what ends up happening when the Ministry of Finance out of Japan intervenes. So, you're right on. Now, let's go ahead and check out some of these dollar pairs. These also reversed on the strong. Well, I wouldn't actually call them strong. They came in at consensus. They came in flat. The US PMIs, the US flash PMIs. Everything came in flat. Aussie dollar reversed some of its gains. New Zealand dollar reversed all of its gains. The pound gave quite a lot back. So after that dovish FOMC, which was this bar right here, I was giving commentary saying, okay, I still have bullish expectations. I think we nailed this expectation down here and up here. Even on the Aussie, we had similar looking expectations. I think this is even a closer hit on my expectations, right? Down, then up, then down. We even got some of the timing right there. New Zealand did not hit this upwards target. The pound, I'd say these are mostly misses. This timing is off. Yeah, sure, the prices are kind of right, but I'm not happy with that expectation to say that's a good expectation to have. So you can also look at this and say, well, these two expectations met. My other expectation was that we would end up at this point essentially going sideways into the end of the week and close at least around or above 109 here on Eurodollar. Nope. Nope. The flash PMIs would like a word with you, Joe. And so European PMIs came out, not good. US PMIs came out, not good. So two down bars there. And just to make it clear, I'll go ahead and hide that so you can clearly see, yet two red bars. The Canadian, right, the dollar CAD, down on this chart means Canadian dollar appreciation. This was one particular chart that was like, I really don't know exactly how this thing's going to turn out, but I bet it's going to go up and then down. And guess what? It went up and then really down really quick. And this was FOMC. It moved close to 100 pips, 99.8 pips on this bar. And I'll be damned. I think we're going to hit this expectation for the closing price on the week. Probably. If we were to close right now, yeah, I'd be quite happy with this expectation holding up. So yeah, some good expectations so far, at least here on the FX side of things. Not all these expectations were perfect. I don't think they ever will be. February was a particularly good month for me. I was calling highs and lows on these expectations and closes, bam, 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 like that. But this is part of the process of learning. You want to figure out, what are my expectations going into the week ahead? How do I think XYZ asset is going to perform? And then with that expectation, be able to react as quickly as you can to new information to update your expectations so that then you can defend yourself or enjoy a ride if you were right. And let's say you positioned long and, for example, on the ES, the thing just keeps going up, 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 and away, right? Wouldn't you have liked to be long right there at the beginning of the week and just see the thing go up, 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 and away? I'll tell you right now, a lot of people on the S&P were very happy to see that. Anywho, let's go ahead and check out some of the commodities. Let's start with oil. This expectation just was flat out wrong. Down, then up. It went up, then down. So flat out wrong there. We've had a bit of a pullback, though, here on crude. It's pulled back close to $3 here over the last 2 days. Let's go ahead and look at our seasonal closes. So most of the time, the close for this week is somewhere around here. So somewhere below this R0.5 pivot to S0.5, this spot right around here. Most of the closes seasonally this week are around here. So I think that's a fairly nominal expectation to have going into the end of the week. I don't think I can really draw a good arrow here just because there's probably not enough time left for going here into the end of the week. So bear with me. Let's go ahead. I added a few more commodities here you might see in my watch list. So nat gas, I'm effectively saying this thing's likely to go sideways, and we'll move on to the next one. And gold. Man, gold did so good up until today. Here we are saying, oh man, this is really high up, right? I mean, this thing was really, really high up. You don't get to these spots all too frequently on gold for this particular week. And now, because of all this extra volatility from this week on so many different assets, if you trade pivot points, the next week's pivots are expanded. So that means you're probably going to be less likely to hit these R2 and S2 pivots unless you see volatility continue to increase. So, as far as strategies go for next week on, I'd say an asset like gold, when it comes down to pivots, I'd be expecting more range bound strategies to kind of make the mark here. Let's go ahead and look at our closing odds real quick. Yeah, I'd say essentially this thing's either going to continue drifting lower or essentially go sideways because most of your closes this week are somewhere around here or somewhere around here. You can actually see 20.83% of closes over the last 24 years are in this R0.5 to R1 pivot spot. And right here, 29.17% of closes over the last 24 years for this particular week close in this S0.52 central pivot spot. How's silver doing? Silver just got kicked down hard. Not so sure if silver is going to be able to close flat from here. It would be nice, but it does look like going into next week there's some negative drift, at least seasonally. How is gasoline doing? Gasoline is drifting a bit lower. It's probably going to try and hold on to a lot of these gains from the last week we traded. And something to keep in mind is that the CPI in the United States for February, the CPI that was reported a few weeks ago, back in March here, or a week ago, that had a big surprise upside on the energy side of things. So gasoline and also some services like housing did contribute to it. There is, though, now more of a concern about gasoline prices in the United States rising and continuing to contribute to an increase in inflation. If you, I got a newsletter from one of the U.S. central banks, regional central banks, that essentially was saying that the retail cost of gasoline in these regions was rising by dimes, which is quite a lot, frankly. That's going to put some more upside pressure on future forecasts and the consensus, and maybe upside surprise potential for the next CPI. So while I would like to stay risk on going into the next week or two, I'm going to be probably playing it on the more defensive side. Because once we get into the week leading into, or the week of, April's CPI release for the March data, I would be very cautious right now. It seems like inflation might reaccelerate. If we extrapolate what happened in this month's CPI and some of the metrics we're currently seeing right now into next month's CPI. So I kind of see a bit of risk there. Let's go ahead and check out crypto real quick. It's holding up its gains from FOMC. We'll see if this is going to end up continuing. Looks like we did set our expectation to go up here, but first it was down and then up. This was the month ahead expectation from way back in the last trading day of February, we drew these lines. And so far, I'd say these two are misses. But this timing might be right. Maybe the thing ends up trading sideways in a channel. One guy I like to follow as far as crypto commentary goes is Joe Saz. And that seems to be his analysis as well, is sideways action here on crypto for at least a little bit here. You never quite know exactly when crypto is going to make another run here. But as far as economic risks are concerned and how they can impact Bitcoin, like here on this big green bar, because when FOMC came out a bit dovish, they essentially held their policy. That gives some relief here on crypto. So macroeconomics can move crypto. So don't let anybody tell you that, quote unquote fundamentals don't matter. Personally, I don't even like saying the word fundamentals. I just like pointing out, hey, these are metrics about how the world works, and the more you learn about the world, the better you can get at trading. So learn how the world works and how your asset interacts with the world, so that then you can get better at setting future expectations. And then when you get new pieces of information, you can update those expectations and therefore set better expectations going on into the future, like these little arrows that we've set here. Litecoin is actually really holding up quite well here. It's probably got some more positive drift in store. I wonder how kind of the rest of the market has performed so far. Looks like ARK did well on FOMC, not so well here on Flash PMIs. Only 7 years of data there. Ford really kicked butt on FOMC. Disney did all right. Now, there is still speculation about whether or not Capital One and Discover are going to do their merger. And it seems like both stocks are doing quite well today still. Nvidia gapped up, but it's still a red day. So Nvidia is still holding in there on this little range from essentially the last week and a half. So not much news on that front either. If you had positive momentum going into FOMC on the equity you're looking at, it likely is still going up right now. Otherwise, if you had no momentum, it's sideways, maybe a little positive on the day. All is nominal in the world of assets right now. Nothing too crazy, to be frank, even though this dollar move did impact the FX market quite a bit. And the yen has been putting a tamper on the returns of itself against every asset, except for, you could say, the Canadian. Canadian's flat. And the dollar. The yen has just not been doing well against the dollar. So I think I should ask you guys if there's any particular chart or thing you would like my commentary on, because man, I was fast today. We're only 28 minutes into the stream, and I've pretty much covered everything I wanted to cover. And tomorrow we'll be talking about these week ahead expectations and draw our expectations for the week ahead in that stream tomorrow. It'll be the same time, 2 p.m. Pacific, 5 p.m. Eastern. You can always hop into the Discord and get notified of when those streams occur. But other than that, I've pretty much said everything that I wanted to cover so far in the stream today. So unless there's any questions, I'll go ahead and yeah, I agree. I absolutely agree. Yeah, there's nothing to really trade right now. Maybe I'll talk a little bit about what my experience here on Euro Dollar was like today. I did take this long here. I felt like a genius because if you look here on a 4-hour chart, it looked like I had bought the low there on the daily range if I go ahead and you can actually use the replay mode with the range probabilities indicator. So I felt like a genius. Actually, I'll go ahead and go a little further in the time zone. So I was looking at this. I'm like, hey, that looks like a good dip to buy. You're at a likely low on the day. And then I immediately felt like a genius, right? It felt really, really good. So this was after European flash PMIs came out, and we felt, I'm like, okay, those are mixed, but they're not terrible. So I'm gonna go ahead and take a shot. It did really well. I'm like, okay, this thing's probably gonna end up recovering and close green on the day and have a big fat bottom wick. Nope. Nope. Now the US flash PMIs came out and took away all my hopes and dreams of having a nice little day trade there. Ended up having to hop out here somewhere around the 880s mark. So that sucks. However, I'm not totally out of Eurodollar yet. I still have this trade here from FOMC on, and that is effectively right now sitting at break even. So it sucks when you're up, 75 pips on an asset, and then it immediately reverses. Those sorts of things tend to happen, and they do. But you know what? You just do everything in your power to minimize your losses, maximize your gains, and to stay on top of things. Maybe I could have interpreted those flash PMIs more accurately, but they were mixed on the European side and flat on the US side. So just by looking at the numbers themselves and without going into the sub indices of those flash PMIs, I couldn't really discretionarily figure out like if it was going to be a net positive or a net negative. And I thought in my head, my gut feeling was it's going to be maybe a slight net negative, but I wasn't expecting it to totally reverse the entire move from FOMC. So this was definitely not an expectation of mine. So yeah, a little bit of trading difficulty, at least here on the euro. I have other things that are doing quite well, so I'm happy about that. So, I mean, I would say maybe the stereotypical you win some, you lose some. But I just don't like that phrase for some reason. It's like very laissez-faire, as they would say. It's a very loosely used uh, phrase. You end up finding, I end up finding frequently that people who use that term a lot, like they overuse it so frequently to describe their trading behavior. Even though I just used it to describe mine, that they frequently don't know what they're doing and they just don't have the mental capacity to figure out what was going on. At least in this case, I can go ahead and review and like, this was obviously mixed, this was obviously flat, it might be a bit net negative, but this was way past my expectation of what that slight net negative would have been here on the $0. So I'm gonna take the easy way out and say you win some, you lose some. Yeah, but everything is fine, Oh no, I had a 3 pip drawdown. Oh no. Time to hop out and run. Now in this situation, it's a big red candle and there's momentum behind it from this big red candle. So I'm like, okay, this thing just has to go. But this one, not quite yet. There's still hope that this thing ends up having some positive drift into the end of the day. At least I would hope so, because I got exposure to it still. But whatever happens. I'm going to keep my eye on the chart. I'm going to be aware of any more economic events that come out throughout the rest of the day, and I'll be prepared. It was a valid day trade. Yeah, I'd say so. you know. Just on those day trades, I really reduce my size, frankly. Even if it's like, hey, you're taking this trade here and you're adding into it there. This was such a small trade. It's like 10 basis points. I mean, I essentially was just like adding a little top off to this trade right here. I'm like, oh, maybe I can get away with something here. I couldn't. I didn't. I think the interpretation and the analysis was right going into it, but that's just how it goes. Let's just try to not have a losing week, right? Hopefully the thing ends up going higher. Otherwise, I am going to fail fast on this. And then try again next week. And yeah, try again. How much do you risk per trade? I use basis points. So usually I do 5, 10, 15, 20, 25, 30 basis points. And I'd like to uh, usually have something behind the trade that's also moving it from an economic standpoint as well. So buying weekly lows, buying monthly lows, I'll use some double digit level of basis points, like 20, 30 basis points. And then for day trades, I'll try and keep it like around 15 basis points or less. Because you can end up in a day doing several trades if it's a particularly interesting day to trade. So yeah, I try to keep the trades in the basis points, and then people are sometimes confused, like why use basis points? That's so low. Why don't you do 1% risk per trade? 1% risk per trade, in my opinion, is like not for everybody who does it, but for most novice traders, 1% risk per trade is gonna put you into drawdowns really, really quick. Because a lot of people don't know how to set their they set their stops either too tight, um, or they don't put a stop on it, or they do all sorts of uh, just ignorant things. I won't call them stupid because they're learning and they're still getting the hang of things. They just do ignorant things, mistakes because they're new, or it's something that they haven't thought of, or they were sleepy that day, or whatever. There's all sorts of excuses that can come along from that. But just the effect of 1% risk per day can kind of spiral out of control, especially if you're using that size for day trading, where you might be taking 5 different trades at 1%. Well, guess what? If you lose all 5 of those trades, which absolutely at some point, if you're day trading every day, you will have a day where you lose just all 5 of those trades. You'll end up being in a 5% drawdown just on the day very, very quickly. It's a lot easier, in my opinion, to do 10 basis points per trade on the day. And then for those same 5 trades, you're at 0.5% of the portfolio. And it's a lot easier if you lose on all 5 of those trades to recover 0.5% than it is 1% risk per trade for 5 trades at 5% of the portfolio. So don't get me wrong, that'll end up reducing the amount of money you end up making. But if you had a trade that does potentially 1 or 200 pips, like 10, 20, 30, 40 basis points can turn into 1 to 2%, maybe more than 2% if it's especially good. Just on the day, if it's like one of those really great days. So yeah, I prefer the idea of basis point risk, even for some swings. But I understand that there are people who do swing and they try to buy a low on the month and sell some high on the month for some equities, and you'll make the equity will move 20%, and it's just for 1% risk you're making a huge amount. So sizing is going to be dependent on what you're trading, what you know about what you're trading, your expectations for the thing. It's not, you can go ahead and find all sorts of formulas for position sizing, but it really comes down to what is it you're trading, why are you trading what you're trading. Really important questions that you should know and have answered before you hop into the trade, right? All right. So I'll go ahead and say thank you guys for watching so far. I'll go ahead and end the stream now. And I will see you guys in a bit.